Okay, welcome everybody to episode 48 of the Volatility Barometer. Glad everybody could join me today. Couple of notes, same pool party from last week, so if you tuned into the live stream, I'm here in this inclusive resort style thing in Dubai, and unfortunately there's a pool right outside my window. So I don't know if you can hear that, but I think these microphones are decent, but again, if there's background music, you know what it is. I'm not playing music in my room or anything. And second thing, I am streaming to two different places now. I'm streaming to both YouTube channels. So just shout at me in the comment section if something looks off, if the sound is wrong or the video's skipping. I think you need more bandwidth to do this, but I did do the internet test and it should be just fine. So hopefully... Actually, my comment section hasn't kicked in yet, so let's just give that a quick second. I see a couple of thumbs up, so there's some people here. Interesting. Maybe this is because I'm actually streaming to two places. I hope that means that I can actually see the comments. If not, later on, I can actually open up the YouTube and probably answer them from there. So thank you for joining me. I'm going to do the same format as we did last week. I think it worked out pretty well, so... Essentially what I'm going to do every week, Monday, Tuesday-ish, our live streams will be on Friday. I'm going to put in the community section of the YouTube channel a open thread where you can just submit your questions, any subject, volatility trading, options trading, all that stuff. And at the end of the week, hopefully we've got a pretty good set of questions and I can get to those first and then circle back and do all the comments. So as you're populating the chat section right now with questions, I can go ahead and do the community section there. So hopefully everything works out. And going to do a new segment today too called Mailbag. I'm just going to answer one of the emails that was sent to me. I get tons of emails every day. Maybe every week I could pick maybe one that answers a lot of questions at the same time, and I can answer it publicly. So that's what we're going to do. But let me show you what I'm talking about, the community live stream first of all. So you will want to go into the YouTube channel, and right here where it says community tab, you can just click in here and there will be one of these threads. So this was last week, bunch of questions. And for the one this week, it is of course episode 48. So give me a quick second here to just check the chat. Just make sure nobody's screaming at me. Tom says, so far so good. Okay, I only see two comments, so I don't know. Maybe there's a little bit of a delay here. But anyway, like I said, I will circle back to the chat and I will just rapid fire through as many as I can. So you can start asking questions there. Let's get started. I actually just looked at this briefly. It looks like there's some good ones, but some of them are longer. So I don't know if I'm going to get through all of these, but I'm going to have to try to speed it up. Everybody who watches my live streams, you know I can go off on tangents and rants and get a little worked up. That's another thing too. I don't know why, but I feel like I'm going to lose my voice today. So I hope that doesn't happen. I've got a drink next to me. It's grape juice, I swear. Anybody who's following me on Twitter, I sent out a recent poll today asking a question about what people can drink on live streams. This is grape juice, I promise. Might have had my fingers crossed when I said that. But anyway, let's get into this. So Vittorio asks, this is a long one. There looks like there's quite a few long ones today. So would it be possible to get an overview on how the VTS options course will be structured? For instance, do you cover details like the followings and the reasons behind? Optimal days to expiration per strategy, optimal price gap between long and the short position, like you did last week with the Iron Condor wings, time of day, when to enter, indicators that you use. Okay, so bottom line, yes. For anybody who doesn't know, I'm just checking if I'm on a live stream. I am putting together a full detailed options course. So I don't want to get too into this right now, but it's a question and I'm going to answer all of these. So here we go. Essentially what I've got planned is it's going to be more of an academy style. So yes, to answer to all of your questions, we will be answering everything in full detail. It will be quite similar to the Iron Condors course that you've probably seen if you're a member of the VTS community, right? So this is an options course specifically for Iron Condors only. There's a bunch of individual lessons. think there's 17 of them right now. There's probably going to be about 25. This is just what VTS members get to see. Just comes with the subscription. But sort of this style, but it'll go a lot further than that. So for example, hopefully you can see this, but this is my rough outline of what the VTS Options Academy will eventually look like. So I am going to include the iron condors as well, but that will be mostly completed. So inside each module, there's going to be many, many lessons, individual lessons, like a video library of, you could maybe consider it the course curriculum, the textbook, so to speak. And then we will also be doing live streams every week, privately, not publicly. These will be private for just people who are in the community, and doing live trading and answering questions and troubleshooting all the issues. But it'll basically launch with 4 segments here. So the first one is just introductory, getting to know me, stuff about the, I don't know, how much of this do you actually want to see? VTS Options Academy. So for example, like I've done some of these already. I've put together basic outlines. You can see they're all just going to be videos talking about basic things. I don't know, give you a couple examples. Universal trading laws. This is of course going to be important, but videos basically talking about introductory things with options. What are the most important Greeks that matter? That's all going to be module 1. Module 2 is probably where it's going to start to be interesting with the strategies. Iron condors, you've probably seen it before, but if you haven't, it is a full course with iron condors. Then we're going to get into the 2 strategies that I feel people will be most interested in. One of them is a volatility strategy. So again, it's going to be multiple videos breaking down every aspect of it. It's not just me sort of giving vague ideas. I'm talking about quite literally giving the exact strategy. So of course, everybody will also get a spreadsheet with the course. It'll have all the VIX futures data, all the cash VIX data. It'll have everything you need, the volatility indexes, all the volatility ETFs, backtested all the way to inception. You're going to need all of this data to actually trade the strategies. So for example, it's not just vague ideas. This is quite literally a strategy that I use that will give you the exact signals. And of course, all the details on exactly how to do it, how to build it, what it all means. Essentially, you will be getting, if we go through all of this, it's simpler than it looks. I think I can probably explain it in about 20 videos, but you'll be getting a full volatility strategy that you can literally take with you, exact details of when to get in and out of the positions, long vol, short vol, all of that stuff. And obviously all the details on how that works, when to take the trades, everything you need. So bottom line, yes, that's going to be it. The VIX option strategy is probably going to be the one that interests the most people. It's my longest running, 12 years now, most profitable, most consistent. And I've got quite a few lessons planned for this one as well. As you can see, there's going to be tons of examples. And then that'll basically be graduation. But it won't stop there. What I'm planning here is this is more like a university academy style course where every few months I'm going to introduce a new strategy. So I don't want to bombard everybody at the start. So we will do this for several months. It'll take a while to do all the live streams. But then once we do, I can build the next strategy, which would be earnings plays. And then I'll teach everybody that over the course of a couple of months. And then I can launch a new strategy, Wheel of Fun, calendar roll, sector rotation. I've got tons of strategies that I can introduce. But the good thing is we can do it at a pace that everybody can kind of follow along and actually learn. But the most important thing is, once you buy the course once, you are a member of essentially the university, and you'll never have to pay anything again. You're just part of it. And when I launch a new strategy, when it's time to introduce directional flies, for example, you're just going to get that added to your course, and you don't have to come back and pay anything, right? But I don't want people to just be hit with 300 videos. It's just going to be a wall of videos, and people are going to quit the course. That's the one thing that you have to be careful about when you're paying money up front. It's not going to be, a couple $1,000s is not nothing. It's not that expensive, but it's not nothing. You want to make sure you finish the course. And I don't want to just basically wall people in and say, here, there's 10 strategies, pick the ones you like. I want to actually do this right. So my work, my quality, I'm going to take my time. I'm going to make sure that it's actually quite good. So I don't know about a time frame or anything. Unfortunately, as I've probably mentioned on many live streams, I already work 12 hours a day. So trying to fit this in and try to actually build out 100 videos plus all the rest of the stuff, I have wildly underestimated the workload here, but I'm doing the best I can, and I see a little bit of light at the end of the tunnel. So hopefully that answers your question there. Essentially, yes to all of your questions. It will be every angle that I can possibly think of. And if during the course somebody comes up with a great question that's something that I just didn't see and I just missed it, well, I can just go ahead and make a 15-minute video and just stuff it into the course, and everybody's just going to be able to get that. It's just an add-on that I can do. So I will probably miss things along the way. I've been doing this for 17 years. I'll probably take a few things for granted, and I won't realize, oh, I'm actually talking to people who've never traded this strategy. Maybe I missed a few things. I can circle back and fill it all in. So I'm going to do the best I can. It's going to be something, I can't use the word guarantee, but I think people are going to be impressed by it. So, and that's the goal for me. At this point in my career, most of what I do is just to sort of build my body of work and make myself proud. And so it's going to be my full effort for sure. Okay, another long one. Wow. I feel as though the options market has become a lot more liquid over the past few years, and as though the CME has expanded their futures lineup. As such, I'm wondering whether you've explored using options and futures with your defensive rotation strategy, strategic tail risk, or tactical balanced. Placing bull put spreads, maybe short put around 20-25 delta, long put 15 delta, and rolling the position up or down depending on the underlying price movement. Okay, very good question. I know where you're going with this. On SPY, SSO, QLD. So rather than purchasing shares in them or purchasing futures contracts in the futures, rather than the ETF. So where this person is going, I don't know if that was pretty wordy there, but where he's going, we basically have 5 strategies right now at the main VTS. Like I showed, we will probably have, I don't know, 8 or 10 more eventually in the options, but this is our main VTS portfolio. 3 of these strategies involve ETFs only, so no options trading. This one tactically rotates based on volatility metrics, bonds, 2 times NASDAQ, utilities, or cash. Tactical balanced, double Dow Jones, cash, gold. And then the strategic tail risk, double S&P, cash, or long volatility VIXM. Now this will eventually go back to real estate when the Fed stops raising rates, and this will go back to short-term treasuries when the Fed stops raising rates. But the point is, all of these are tactical rotation using ETFs only. The question he was asking is, would we transfer this over and try to transfer them all into option positions? And my quick answer is no, I would not do that. These are trend following strategies. And whenever you're dealing with trend following, especially in something that isn't overly active, like you're talking about 3 trades per month, give or take, strategics a little bit more, but they're not overly active. Let's say 4 trades per month. The ETFs themselves are actually very efficient for that, because I don't know if I'm going to be in the position for one day. If volatility just flashes something and I get in, and then it flashes back down and I get out, it could be a one-day trade. I could also be in it for 3 months straight without changing the position at all. So whenever you're messing around with options, of course, instead of using just ETFs, now you're introducing not only price, which is what an ETF is, price delta only, but then you're introducing time, you're introducing volatility, you're introducing, different risk reward ratios. It wouldn't be the same strategy. So it's not that you couldn't do it. You definitely could transfer anything that you do in the trading world can be represented with options as well. But it wouldn't be the same strategy, especially a bull put spread, bull call spreads, vertical spreads. That's a totally different risk reward ratio. It's no longer trend following, capped gains, capped losses. It's a totally different structure. So if anything at all, I would do stock replacement, like buying really deep in the money calls to represent the QLD, maybe 100 days out so that you don't get hit by that bleeding theta. But essentially, it would be stock replacement or just the ETFs. They are the most efficient. So that's a kind of a roundabout way of saying no, but that is a good idea. And like I said, you could create any strategy you want to be trading these ETFs, to be tactically rotating through different ETFs. It just wouldn't be in the same spirit of what I have built. Not to say that you couldn't do it just as good that way. You'd have to start from the ground up and basically build your own strategy. I don't think mine would efficiently transfer over into vertical spreads. Stock replacement, sure, but no point doing that. All right. Do you have an approximate date? Okay, options again. When the options subscription service will end up running? No, but I'm trying my absolute best. Besides explaining how each strategy works, are you going to do the Iron Condor? Will there also be a daily newsletter like the current one in VTS proposing entries in the various strategies as if they were a diversified portfolio? So that's an interesting question. To the first part, I don't know a time frame, but I'm just getting through it as fast as I can. As far as, sorry, boy, I lost my train of thought there. Let me see it. As far as the signal service. So it might come as a surprise to you. I don't know what people know about this type of thing where you're giving trade signals, but it's actually more time consuming than people might think. It's not so simple. Oh, I'm just sending out an hour a day of a daily email. It's fine. What you have to understand is that anytime you do that, not only is there a lot of stuff behind the scenes that you have to make sure you're doing correctly, but there's also going to be an enormous amount of questions. And that's really where the bottlenecks happen in my work, where everything that I do, everything I explain, every signal that I give out, there's going to be 1,000 people asking the same question 1,000 times. So it's actually a lot more time consuming than you think. So what I'm going to do, and of course, the VIX options strategy shut down because of time constraints. I just had 5 hours of emails every day. I couldn't handle it. So it wasn't because of, performance was very good. There was 600 people following it. It was a very popular service, but I just couldn't deal with the email overload. So I had to revamp the whole thing, have a new idea, launch it as an academy style with 100 videos. Maybe that'll reduce the email load. So to answer your question, not right away. I'm not planning. I don't think I'll have the time to do 3 businesses on top of each other, but it's an interesting idea, and I do manage my own options portfolio, complete, diversified, with all those strategies. Of course, I will tell people how I do that, but as far as the actual daily signal email, maybe we'll leave that until we get, 5 or 6 strategies in the portfolio. We're going to launch with 3, and then every couple of months, maybe I'll add another one. Down the road, sure, we could do that. But that's the point of the live streams as well. We're going to be doing a lot of live trading together. So it's not going to be without entries and exits and risk management. That's all included. I'm just not sure I want to commit to a 3rd daily email and probably what would amount to 3 or 4 additional hours per day of answering emails. I'm not positive that I'm going to do that. You'd be surprised. Like, people have trade execution issues pretty much every day. I've got a lot of emails pretty much every day. It's more work than you think. So how did you get into the world of finance? How did you transition from pro golf to investing? Also, wouldn't it be nice if you had a fan meetup once a year? I can answer the second one first. I'm open to that anytime. I travel to many countries throughout the year. And if I'm ever in the area that you're in, by all means, shoot me an email. I'm in Dubai right now, so I am a golfer, of course. My back's too hurt now. I think probably I won't be able to play for about a month. But a month from now, if you want to go golfing and you happen to be in Dubai, shoot me an email. We'll go to the course. I'm a member at Emirates Golf Club, just down the street from where I am right now. And we can go play golf. Or otherwise, just call me for a coffee or whatever. I do work insane hours, so don't expect I'll be hanging out all day long or anything. But yeah, I can definitely meet up for coffee if you're in the Dubai area. First question, how did I get into the world of finance? How did you transition from pro golf? So essentially, I was always interested in investing and finance. I did math and economics in school. So really, the golf aspect was the golf that was the interference of the finance career. I can't remember what that principle's called, but there's a specific word there's this principle: the worse the conditions get for somebody, the better the long-term outcomes. And I don't really know what it's called, but just to give you an example, and I don't want this to sound arrogant, but I was really good at golf. I was, I was the highest ranked player in the country for a while. I was quite good. My point was, if I was a little bit worse at golf, I wouldn't have turned pro, and then I would have just jumped into finance right away when I was 24 years old. As it happened, I was cursed with a pretty good golf game. And so it got to the point where there's no way I'm not going to turn pro and give it a shot, right? I'm too good to give up on that dream. I would have probably hated myself forever if I just worked with an investment bank when I was 24 and just never went to the pro golf route. So I was good enough to turn pro, but I was also too injured to actually make a good go of it. So, obviously you need to practice every single day, all day, every day to be a professional anything. And I just didn't have my body was falling apart in my 20s. And by the time I got to 30 years old, I was practicing twice a week maximum. And I had to take tons of time off and all kinds of joint problems and, tendonitis type things and, missing, sounds crazy, but kind of missing bones in my body. I've got this sort of bone disease, so to speak, where when you're born, you have a lot of soft tissue. And then as you get older, it kind of hardens. And this is where your joints and your tendons sort of rest on your joints. And I've got a lot of them that are like really soft tissue and they're not functioning properly. So sometimes I'll just wake up and my thumbs don't really work properly, or my ankles are feeling all jacked up. It's just my shoulder's out one day and then the next day it's not. It's really weird. And it's kind of like a tendon issue. So for years, I didn't know what it was. And then I don't know if you could call this lucky or unlucky, but I'll tell you the story of how I found out that I have this weird thing. For years, I just was withdrawing from many tournaments and, couldn't really get a practice schedule. And then one morning I'm going to a tournament. It was the third round of a golf tournament, 7 a.m. in the morning. I was holding the door open at 7-Eleven for the guy who's loading the Coke trucks. I was just getting a Gatorade in the morning on my way to the golf course. And he dropped the entire crate of Coke on my foot and shattered my foot. So I broke my foot in like 3 places. And I went to the hospital and they did a bunch of x-rays and MRIs. And that's when the doctor's looking at it like, your feet look like they're missing quite a bit of the important stuff in there. So they kind of investigated further and they realized, oh, wow, your joints are not working properly and this is going to be a problem. And it actually affects small, like little joints. It's not like I have a spine issue or something. I've got a little pulley joint issue in my thumb. It's really stupid. But anyway, my golf career ended. So that's how I got into finance. I retired from golf when I was 30 years old and I got into finance. If I was a worse golfer or if I was a better golfer, probably would never have circled back to investing. But I was just at that stage where there's no possible way I was not going to try to turn pro. But I didn't find out until 6 years into my pro career that it wasn't in the cards for me because, my body's a mess. So that is the sad story, but it's also a good story because for the last 17 years, I've been investing and I love what I do. It's just, you can imagine when you're 30 years old, and I don't have a master's degree, I don't have an MBA or anything. It would have been difficult for me to move and transition to like an investment bank at 30 years old with no MBA. So I just decided, screw it, I'm just going to do it myself. And I just built everything myself. I started writing, I started doing videos. Obviously, track record's important. I've done super well the last 15 years. So that's how I got into this. I just made it happen because this is my passion. I just did it. Didn't ask anybody's permission, didn't have a job, didn't ask anybody for a job. I just did it myself. This is just what I wanted to do, and this is just what I'm going to do. Kind of like my golf career, I would highly recommend people don't try to be a professional in sports because the odds of making it are, 1 in a million. But, when I was young, nobody's going to tell me that. I'm the type of person that if I want to do something, I'm just going to do it. And yeah, investing was like that. I saw it, I liked it, I'm interested, so I just did it. That's the story. But, in hindsight, of course, regrets and all that. If I was a worse golfer, I'd probably be further along with more experience. If I was a better golfer, I'd probably be a multimillionaire on the PGA Tour. I was kind of right there in the middle. So it was fine. I don't mean to sound like I regret it. What do you think explains the generally low levels of VIX in 2022 relative to the declines we have seen in the market, I assume? The S&P going down about 20%. VIX didn't really respond like it normally would. Going forward, should we stop looking into VIX as a hedge? So I think that just in general, what explains it, there's probably several smaller things that contribute, but one thing that you could point towards is the fact that the VIX index is a calculation based on S&P 500 options activity. And it's basically a strip of 30-day options, at the money, out of the money, everything included. And it's calculated based off that. But as you've probably seen online, there's been, quite a bit of mention lately about how the short-dated option contracts are just exploding. Got to be careful with that a little bit because you should be more interested in notional value and relative percentages. But, some people post these just alarming looking charts of basically the number of contracts. You want to break down a little further than that, but it's not wrong. There is actually a rise in shorter dated contracts that will not be included in the VIX calculation. So I would say that that's probably somewhat of a contributor. You've got particular regulations that potentially are forcing institutions and large players to really hone in on those 0 DTE expiration contracts. It's basically, a little bit of a regulatory loophole where essentially your margins and your capital allocation ratios, they're not marked to the clearinghouses until the afternoon, like late in the day. So I suppose, and I'm not saying anybody's doing this, but I suppose you could. If you were an institution, if you were holding a bunch of 0 DTE options, you could actually hold a position that doesn't actually ever get registered at any clearinghouse, and you could have a directional exposure that under normal capital requirement ratios you wouldn't be allowed to do, but because this is the investment world and people are going to find all the little loopholes they can do. So I would say that that's kind of a large part of what's going on there. As far as your second question, I would say that you should probably always ignore the VIX index itself as a volatility metric. Like, I don't use it for hardly any of my trading. The VIX index is only useful when it's paired with other things. So for example, the VIX index would be useful if you're talking about, say, the VX30 to VIX roll yield. This would be where the front 2-month VIX futures are trading in relation to the cash VIX price, the spot VIX, and then relative to the number of days to expiration. This would be important if you were trying to calculate, where the volatility ETFs are going to be going. So in order to know that the VXX is going to be, a day from now, 5 days, 21 days, it's projected to be at about 1164. UVXY might be at 512. These things are going to be based in some respect to the VIX index, but not on its own. Like this VIX index thing on its own, it means nothing. It's a nominal number. It's totally irrelevant. A VIX of 20 means quite literally nothing. It could mean that it's high volatility, low volatility. It could mean it's a dangerous market. It could mean it's a calm market. Everything is relative. So you have to pair them with other things, like the VIX to VIX 3M ratio, for example. If you wanted to say sort of shorter term 30-day risk in the VIX futures market compared to, say, the 93-day risk, that's what you're looking at. You can start to use the VIX that way. But in general, no, the VIX is pretty useless. You said specific to hedging, but hedging with the VIX, again, it's one way to do it. Problem there, of course, is that whenever you're looking at data for the VIX and data for hedging on the VIX, you don't ever know what that institution or that maybe it's a retail trader, you don't know what their actual exposure is. So oftentimes you see people on Twitter, because of course it gets eyeballs. You'll see the 50-cent trader stuff where people will say, wow, look at that massive block of VIX calls. That means that somebody at the institutions knows that the S&P is going to crash and this is so bearish. Yeah, maybe. Could also be a hedge on a very long, net long portfolio. And what they actually want to happen is the market to scream higher, and they want those VIX calls, that 50-cent trader, maybe they want those to expire worthless, because that means their overall portfolio would have done extremely well, right? So you never know. If you're not in the room, you don't know what that exposure means. And the S&P 500 options market is only one place of many that institutions and traders use for hedging. So on its own, it's kind of useless. Like, I would say you pretty much always ignore the VIX unless you have a specific way that you're going to apply something to it. Like for me, I do like the VIX, the cash VIX term structure, the VIX 9D compared to the VIX 3M, the VIX 6M, and then the 1Y. This is from, 9 days out all the way to a 1 year. So you've got 9-day, 30-day, 3-month, 6-month, 1 year. You can gain a lot of very useful information tracking this. This is why it's in my daily email every day, and it has the value that it's currently at, plus the percentile based on all the indications of the past. So right now, percentile-wise, the VIX 9D is at 35, the VIX 3M is at 62 and 62. Well, what is this telling us? Well, this is basically saying that short-term fear is muted, but midterm and long-term, there is still some worry out there in the market. And I suppose that kind of tracks with how I feel things in the last 1 year or 2 years. There's a lot of people who don't mind taking on short-term risk right now. But if you ask them, hey, do you want to lock in some 3-month long VIX trades, people will be like, well, there's a lot of risk there. I'm going to need to get paid that premium. That's a lot of bad things can happen, especially in 2022. Everything seems so uncertain, but I'll go ahead and take a 9-day trade. I'll go ahead and take a 1-day trade. So yes, you can start to make those comparisons between, but hopefully I answered your question. Essentially, I don't like the VIX. I rarely use it, and on its own, I never use it. All right, I'm going to try to speed up, so have some. I almost said wine. That would be silly. You can't drink wine on a live stream. It's grape juice. All right, I think last live stream you mentioned you're a Dubai resident and therefore not having to pay taxes. What are the requirements to become a resident there and in other low tax, tax-free countries? Second question, or being a modern nomad, living here and there every 3 to 4 months, do you have to pay taxes at all? Uh-oh. Somebody's wanting to get into tax fraud. On the other hand, how would it be possible to have a banking account, brokerage account, without being a resident somewhere? Okay, I can do my best, but I'm not a super expert on this. I've been a digital nomad for a very long time, and I do a ton of research. Obviously, you've seen my investing. I cover everything from every angle. I've got 100 spreadsheets to calculate one little thing. So I know a lot about the digital nomad lifestyle. I'll be specific to Dubai. So basically 3 ways you can do it. Yes, it's tax-free. It is totally tax-free. That's not a myth. If you've heard like, oh, how can that be? It's true. You don't pay any taxes here. No income, no corporate, no nothing. They're introducing corporate income taxes soon, but as of right now, no. Anyway, easiest way to become a Dubai resident is to buy a house here. And it's actually a super reasonable hurdle rate. It's basically 1 million local dirhams, it's pegged to the US dollar. So it's about 272,000 US dollars. If you buy a home worth that much money, you get residence here. You basically get a 5-year resident card. If you buy a home worth 3 million, you get a 10-year resident card. But 5 years fine, you can just renew it over and over again. They don't, kick you out or anything. But you have to own it outright, so you can't take out a $300,000 mortgage and then mortgage the rest. You have to own the home in its entirety. Fortunately, Dubai real estate's super cheap, so you can get beautiful places on the beach, great views for $300,000. You really can. So that would be the easiest way to do it. The second way to do it would be the way that I did it, which is establish a company here. Ridiculously easy. You wouldn't even believe it. Like, I'm Canadian, and to do anything in Canada, the bureaucracy and the red tape, it's insane. It would take months. Dubai, it took me, I hired a lawyer, of course. I like everything to be done right. So I paid about $16,000 total US dollars to get the lawyers to do everything correctly. But my job in that process was no more than 5 minutes. And I'm not joking. Like, they prepared all the documents for me. And when it was finally time to do something, they sent me to this building. They accompanied me. They picked me up at my Airbnb. They drove me to this building, took my number, told me which desk to go to. I waited 5 minutes maximum, went to the desk. They said, sign this paper. I signed it. And they said, you're okay. You're a resident. And I thought, and this is something that comes up a lot when you're in Dubai, you kind of walk away thinking, that's it? Like, you mean I'm done at this desk, right? Well, I have to go somewhere else, of course. I have to come back in 2 months and sign all the paperwork. Like, no, you're done. That's it. It's 5 minutes. So there is quite literally zero bureaucracy here. It's really amazing. So that's how I did it. I established a company. What is my company called? Volatility Inc., I think. Volatility Incorporated. And I basically just do what I do in Dubai. I'm a Dubai resident. You don't have to stay there. You don't have to live there. The rule is essentially to maintain your residency. You just have to flash your passport once every 6 months. Now, I happen to love it here. It's an incredible place to live, so I will do more than that. But technically speaking, you could live wherever you want, and you could just duck out and make a trip every 6 months. You just can't be out of the country for longer than 183 days consecutive. If you do that, you lose your residency. If you do 182, see you in 6 months, basically. Pretty easy. Third way to do it would be to actually get a job. So typically you would just get hired overseas before you come here. They would arrange all your paperwork. It's super easy. Again, no bureaucracy at all. And you just go ahead and come here and you work. Now, what I would warn you against, if you're going to go the work route, Dubai is a working, like, they work long hours here and they expect a lot. And from what I've heard, obviously being tax-free has a lot of benefits. Having the best weather, having everything in Dubai is the biggest, the best, the fastest. It's an incredible place, but you will be expected to work long hours and you get treated very well. Everybody's here is just ultra polite. There's zero crime. It's, listen to me talking it up. But it is kind of like it gets a bad rap, like online, they'll talk about negative, but when you come here, it's just a different world. But if you're doing it the third route, you should expect to work a lot. So what I would say is do the second route, establish a company. It has to be an actual company. Like I think the rules are incredibly lax. I think you have to have 3 banking transactions to qualify for active company. It doesn't have to make any money. You don't have to clear any profit hurdles or anything. It's just, they just want you to know you didn't just sign the 5-minute paper and then just stay, right, and live on vacation. It has to be a legitimate company. Now, this one, I don't need to get into this because you're probably the only one interested in this stuff, but I feel like you said something here that's illegal. So I definitely want to steer you away from doing this. Please don't do this. Essentially, by law, you have to have a legal tax residency somewhere. You can't just bounce around from country to country. This is this old myth that, look, if I'm in 6 different countries for 2 months each, who do I pay taxes to? Well, the truth is, all 6 of those countries can come after you for taxes. And because there's new laws in the world, this isn't 1980 where different countries can't talk to each other. This is a situation where, let's say Canada was one of the 6 countries that you went to for 2 months each. The CRA can come to you and say, okay, you owe us taxes. You live here. You say, well, I was only here for 2 months. You say, well, that doesn't matter. We think that you were here. We can prove that you rented an apartment or you have a cell phone and you live here. You have a bank account. You live in Canada. You'd be like, no, I don't. And the CRA will say, that's fine. You can say whatever you want. All we need is for you to prove that you paid taxes in a different tax residency. That's where you're going to run into an issue because they're not going to throw you in jail. They're going to give you the option. Cool, just show me that you're a tax resident somewhere else and then enjoy Canada. Come in as much as you want, stay as long as you want. Well, I think it's 3 months and then you can extend it. But the point is, any country at any time can ask any citizen to prove that they're paying their taxes. That's where you're going to run into a problem because you're going to need to be able to prove that you paid taxes somewhere. So don't do that bounce around, nobody will ever find me thing. That is illegal. And tax fraud is a serious crime. So make sure that you're doing it right. And fortunately, in this world, it's so easy to do and it's cheap and it's efficient. And, I was a resident of Panama before I was a resident of Dubai. And it's the same thing. You flash your passport once a year and you're an official Panama resident. No taxes, tax-free. Not technically. Panama's a little different where it's called a territorial tax system where they do have full tax rates, and maybe it's 20, 30%, but they only tax local income. And of course, I only had 1 Panama resident or 1 Panama subscriber, 2 at one point. So I think 1 year I filed taxes with $2,000 income or something. It's tax-free. There's plenty of ways you can do it. You can go to plenty of other countries that are tax efficient or tax-free. Don't assume that, a lot of people think that these tax agencies are stupid. You have to understand that there's quite literally tens of thousands of people working at these agencies, and their only job is to find people who are dodging taxes. Don't think that you're off at the golf course and you're doing your work and you're doing all this and you're not doing any work to avoid them. They're working all day long to find you. Who's going to win that game, right? They're a sleuth and you didn't give it a second thought. You're just, dancing around the world. They're going to catch you. Eventually somebody's going to come knocking and they're going to just say, hey, look, we'll trust you. Just show me something that you have a legal tax residency. And then you're going to be, crickets. And that's where it's going to be a problem. So do it legally. It's super easy to do. I'm not recommending Dubai. It's just, I'm a golfer. I love good weather. I love beaches. I love crime-free places. I'm from Canada, Vancouver. I spent a lot of time in Vancouver. I'm not a huge fan of tent cities like right next to my house. And I'm not saying that to be discompassionate. I don't think it's good for them either to be living on the streets, quite frankly. I think the Canadian government should probably do something about that and provide housing for them and food and educational programs, all of that. It's not good for the residents. It's not good for them to see, literally thousands of people living on the street in a neighborhood that homes cost $2 million. It's bizarre. So Dubai has none of that. It's just, it's a wonderful place, but it's not for everybody. I'm not telling anybody to move here, but that's my Dubai experience. It's actually remarkably easy to become a resident here. A lot of benefits. Okay, God, I've been going too long. I'm going to speed this up, I promise. Really looking forward to your 2023 videos. Unfortunately, I'm back in the US working and I won't be able to watch the stream. I'd like to know about the backwardation and Contango, some concepts and ideas about the two and how to approach the market as those conditions evolve. Cheers. Okay. I don't like to do this, but I do apologize. I have to speed up a little bit. So you go to the YouTube channel, and what you're essentially looking for is I've done 2 videos specific to that. This one is called What is Contango? This one is called What is VIX Backwardation? So you want to watch these 2. Of course, I make videos to sort of expedite the process of when people are asking a bunch of questions. I probably answered about half of your questions in those videos. The other half of your questions would probably be handled. Just the one thing that you kind of want to keep in mind when you're talking about Contango and backwardation is these are not as simple as people think it is. Like a lot of people think that it's a flip point for something. Like if it's in Contango, that's a green light to be long equities or short vol. And if it's in backwardation, well, that's a time to be, cautious and the market might crash. It's not a convenient cut and dry flip point. Of course, the VIX futures are in Contango about 84% of the time. So 16% of the time, you're talking about that's an awful lot of the market that you are deeming to be safe. If you're using Contango backwardation as this, some type of flip point or something. But what I'm getting at here, which direction do I go? Sorry, I've got a billion spreadsheets. What am I looking for? Bear with me. Okay, let's just go right to the end. Oh, here we go. Cash VIX. What am I looking for? VIX futures. There it is. So, you can see here that the M1, M2 VIX futures are in Contango 83.73% of the time. So 84% of the time they're positive. You're talking about a flip point that's totally meaningless. And a lot of people, when they start learning about Contango and backwardation, they fall into this trap. Like, I'm going to short vol when it's in Contango. That's a crazy amount of time to be short vol. You can see even the 30th percentile is 3% Contango. I wouldn't be shorting volatility in the 30th percentile. Remember, that means 70th percentile above that is better conditions for short vol. That means you're going to be short vol 70% of the time. I think that's introducing a little bit too much risk, if you ask me. But certainly if you're using the flip point of backwardation Contango, now you're talking about being long equities or short vol 84% of the time. That's crazy. And then on the flip side, if you're using backwardation as a signal to go long vol, for example, you're talking about 16% of the market, you're going to be long vol. I'm much closer to 2 or 3%, right? So I would be pulling these numbers way down. I would be like, I'm only willing to go long volatility when Contango is, or backwardation is steep. And I'm only really willing to go short vol when we're talking about truly stable markets. So that's all I would say. Of course, you're going to have to run your own system and strategies, but you don't want to fall into that trap that this is somehow this miracle signal where, boy, shorting vol is so easy. All you do is wait for Contango, and then there you go. Money falls from the sky, ATM machine. This is, all that stuff that people say. It's just totally not true. So that's what I would say. Watch my 2 videos, and apologies. Let's keep going. As I know, all your strategies are created based on a calculation and experience from the last 15 years. It was a time of quantitative easing, interest rate cuts, printing money all over the world. Why are you so sure that your strategies will still perform well in the future, as I can imagine that the macro environment can be totally opposite, like the 70s and 80s? Really good question. So, of course, that part where you said, how can you be so sure? Nobody's sure about anything, but I'm confident I can say that. The reason that I hone in on volatility so specifically and in such detail is because volatility is quite consistent over long market periods. It's really the only thing that is consistent. If you're using other technical indicators or macro signals, for example, you're right. You could totally miss it. If you're trying to use the same macro indicators from the mid-2000s to apply to 2023, well, you're going to have some problems there. But you'd be surprised how similar the volatility market is now, 2015, 12, mid 2000s, even back into the 90s, the 80s. You'd be surprised because remember, I'm not using absolute nominal numbers for anything that I do. Everything is relative to other metrics, percentile rankings, inflation adjusted, all these things. So basically a 95th percentile vol event in 1995 is going to be the same result for me as a 95th percentile vol event in 2023. The nominal numbers might be different, right? The market conditions might be different, but my reaction to that volatility spike will be the same. When it gets over about 60, 65% percentile wise, I'm going to be moving to safety. Now, the safety that I choose might change. Like currently we're using gold. You could make a case that maybe gold isn't the best safety position going forward. I mean, once the whole crypto market launched, I suspect gold has just kind of fallen out of favor, so to speak. Like, this should be an environment where gold is performing pretty well. You got runaway inflation, you've got massive debt and money printing, and gold's just gold. So, I mean, you could make those cases like we might have to, over time, over every 5 or 10 year different volatility regime, we might have to switch the ETFs we use. But like I said, my response to what it means when volatility is going from low to mid to high in any market in any time frame, it's the same reaction. I'm going to go from aggressive to cautious to cash to maybe aggressively long vol. It's the same reaction to every volatility market. So that's why I've had a track record that has been so consistent for so many years, because I'm using metrics that, while the nominal number may change, the relative changes is actually remarkably consistent. So I think volatility is the best and arguably the only place to get trading signals from. I know people would push back on that. Maybe you're a TA guy, maybe you're a macro guy, whatever you are. I just personally believe there's nothing as consistent and predictable as relative volatility regimes. So confident, not positive. Let's say that. In regard to the earnings option strategy, this is a long one. You guys got to start asking shorter questions. What do you think about the double calendar one day before earnings and close it after? I know that after earnings, there is an IV crush, implied volatility crush, but when you use double calendar, the IV crush of the front month is bigger than the back month. I'll circle back to that. I tested it a few times and it worked nice from perspective of risk management, small wins, small losses, wide range. Okay, when the underline moves up or down and earnings make profit quicker. Iron Condor, when I tested, was a lot of small wins and one painful loss. So essentially, I don't ever like to just say, oh, I disagree or you're wrong, but I'll push back a little bit on this. So you are not wrong that on a very short time frame, calendar options and maybe a double calendar, like you're saying, there's very little difference between a single and a double calendar, but you're not wrong that on a very short time frame, it can behave as a short volatility position because the front month of that calendar is the short month, and that one is actually going to zero or close to zero because it's going to be decaying faster. So it will depend on the expirations you choose. If you choose something for the short month really close to the earnings report, then yes, you can build a trade that's short vol, and it would be very similar to an Iron Condor. The thing that you're overlooking is that calendars, diagonals, iron condors, butterflies, iron butterfly, whatever you do, those spreads, they are all based on a very similar principle, and they all behave very similar, which is they're market neutral trades that you don't want the price to deviate too much. So the concept, there's nothing wrong with the concept. It's just that every now and then you're going to get an earnings announcement that shocks way past your price stops. It's going to go like 15% when you're selling pennies of premium. It's going to move dollars. That's the problem, is it's the old adage of picking up pennies in front of the steamroller. So what I do, and you've seen the recent video that I did, where I was actually talking about the fact that, Clips channel. Where are you, Clips channel? Clips channel. If you go and subscribe to my Clips channel, I did this one, buy straddle options. Watch this video. It's only 4 minutes, But if you flip that on its, upside down and you use a long volatility position that's open 10 days before and you close it before earnings, that trade cannot lose nearly as much money as the other one. It's true that you might not get quite as many easy wins, but you will not get those shock moves that just blow past and you end up giving back, 6 weeks of trades in 1 week. That typically happens when you're doing your style. I personally, unless there's a reason, like if, again, it's all about relative volatility. So if you're talking about an earnings season where it's particularly high volatility, then yes, I will allow myself to do the sell the market neutral short credit spread, wait till after earnings, and you just kind of hold on to that bull and you hope it doesn't buck you off, basically. But for the most part, my thresholds are going to be skewed. So I would much prefer to have volatility relatively low and get into long calendars because I can control that trade much better. So maybe bottom 40th percentile or something like that, I'm all green light for my long positions. If you're talking about the shorts like you were doing that is actually going to decay when you get the IV crush after, I might bump that up to 20%, 25%, something like that. It's going to take a particularly high volatility earnings season for me to be tempted to be selling those things. So I need to be paid a lot up front or it's just not worth the risk. And I think you're misunderstanding slightly the dynamics of a calendar. It's not actually, the double calendar isn't really going to behave any different on a short time frame to any of those other spreads that I was talking about. Making it a double calendar doesn't really do anything. It doesn't even widen the wings, to be honest. It looks like it would, like if you were in a trading software, like this is the Qs. I have a calendar open right now, so I can show you what they look like. You can imagine like a double calendar. It will appear like it's wider. Like this turquoise line, there will be another one over here, and it'll look like a double tent. And you'll think, oh, wow, this is such a wide range. This is a way better trade than a single calendar. But the thing that people are overlooking is this pink line is the daily profit curve. This is the only thing that matters. This turquoise line is expiration prices only. We're not going to hold it anywhere close to expiration, so that's irrelevant. This pink line doesn't change from a single to a double calendar. It's the same shape curve. It's the same stop losses, stop gains. Everything will be basically the same. It's just you're deceiving yourself into thinking that making two of them widens it. And then you're probably thinking it's going to look something similar to a very wide iron condor. No, it's just going to appear that way. But this pink line is still going to be the same shape. Hopefully that kind of answered the question there. Okay, we're rolling through this here. How can I teach my kids work ethic? They're in early elementary school years, so I think there's still hope. How do you teach your kids work ethic? Well, full disclosure, I'm not a parent yet, so if you want to say, hey, what does this guy know? Why is he talking about this? He doesn't know anything. That's fine. I will take that L. But basically, I am an extremely hard worker. I work very long hours, and I actually enjoy it. But there's basically two components to this, and by far one of them is going to be just easily the most important thing. And, I don't know if this is the answer that you're expecting me to say, but how do you teach your kids work ethic? You show them a good work ethic. This is really the only thing you can do. How do you teach your kids how to have better relationships? You make sure you and your wife get along really well. How do you teach your kids good financial, habits? Well, you make sure that your wife and you do make good financial decisions throughout their life. There's no better teacher for a child, especially an elementary child, than to just mirror their parents. So for me, I'm just this way. This is just what I've always done. And probably the reason my dad, he ran his own business. He was in the oil industry. He was bed at the same time every day, wakes up every day, wakes up at 6 in the morning. He's at work, never misses a day, never sick, never complained, just works really hard. My mom was a nurse. She worked full-time schedule, sometimes night shifts. When I was in elementary school, or maybe, just tail end of elementary, she went back and she did her master's degree. So she's working a full-time schedule, plus doing a master's degree, plus raising 2 kids. I was raised in a home with work ethic. So it would be odd I mean, it would be bad parenting on their part if they allowed me to not have that work ethic. Like, they're working so hard, they did expect, the kids to be working hard. So they kept me busy, and I was in a million sports when I was growing up. I was always an athlete. So, when I was young, I was in gymnastics and soccer and swimming. I was a competitive swimmer. I was in the pool 8 times a week, and I had Sunday off. You're thinking, well, this guy's math is terrible. How can you train 8 days a week and get Sunday off? Well, my math isn't bad. On Tuesday and Thursday, we train twice. So I wake up in the morning, 5 in the morning. I'm in the pool at 6, 2 hours of training. 8 o'clock, you shower, you go straight to school, all day at school. At 4 o'clock, I'm in the pool again until 6, shower up, go home, do my homework, wake up the next day, do it all over again. I was doing this when I was 7 years old. Like, I was a competitive swimmer when I was a really young child. I was in the pool for 18 hours a week and in school. And then when I was older, I was basically a quasi-professional golfer since I was 16 years old, competing in tournaments and doing a work or a school schedule. Like, I did a double degree. I did math and economics in university and played pro golf at the same time. Like, it's just what I've always done, but that's always what I saw in my house. Sometimes I say that to my wife all the time. Like, in Taiwan, you see it's very common for women to not work, not have jobs. They're a stay-at-home mom, but they still have, 1 or 2 full-time maids, in the house. And I always think, well, boy, my mom and dad, my mom especially, we didn't have any maids growing up. I mean, they raised 2 kids. They both worked more than full-time jobs. They managed to do it. So it's just work ethic. And the things that you see in your house, you end up growing up and taking on some of those traits. So I learned from the people closest to me. And that, I think, again, yell at me if you want, like, hey, this guy doesn't even have kids yet, so what does he know? That's fine, but I would say that whatever you do, it's going to be a very high probability that your kids are going to do the same thing. So good or bad, probably even bad more so. Like, if I know you're probably not lazy, but let's say you're super lazy, you play video games, you come home from work, you kind of complain it was a long day, you play video games, well into the evening. Yeah, your kids are going to pick up that really easy. Like, if you have a solid work ethic and you're a really hard worker, there's still no guarantee your kids are going to be strong, hardworking people. But if you do the opposite, the negative, they're probably almost certainly going to mimic the negative, because that's the easy way out, right? So my parents did 2 things. They were exceptional role models as far as work ethic, and kept me really busy. So the combination of both of those, I think I just grew up and, I don't even notice it. It is what I do. I can give you an example just today. What did I do today? I woke up at 8, got my computer, went to the buffet. I'm at an all-inclusive Dubai resort right now, so there's breakfast and dinner buffet. It's pretty sweet. Got to the buffet, took my computer, did my work, started at 8 o'clock. I worked till 3, right? So basically I did 7 hours uninterrupted work. That's about my limit for super focused work. And then the rest of the day I start prioritizing the things that require maybe less focus, So at 3 o'clock I went to the gym, but I didn't just go to the gym and, lift weights and stuff. I put my computer on the chair in the gym and put in my headphones, and I edited an old live stream. For 2 hours, I time-stamped it, I organized the videos while I'm working out in the gym. And then I wanted a break, like an actual break. So I went out on a run and I ran, 16 kilometers today. So I ran at about 4:30 or something like that, ran till 6 o'clock, 16 kilometers. But again, I wasn't just out there jogging around. I was training, and I was listening to a podcast teaching me about how to launch my option service. I was listening to an audiobook called Launch. It's pretty cool because I have to learn stuff. So that's a good multitasking place. So I worked while I was running, and then I took my computer to the buffet at nighttime at 6:30 at night. I ate and sent my daily email to the VTS community while I was eating the buffet, and then came back here, prepared my live stream, and here I am. I'm going to work till 11. It's 11 o'clock right now. So I worked today quite literally from 8 until 11, 15 hours, went to the gym, ran 16K, did a live stream, edited a video, wrote a script for a new video, edited some other videos. I worked 15 hours today. I had a great day. I loved it. There was no time today where I thought, oh boy, I really want to play video games. I've never played video games. I've never done those things. I I can go 2 years without turning the TV on. It's just the things that I like to do are the things that I grew up doing. Like when I was 7 years old, training, swimming 16 hours a day and then being in school and doing homework. That was my life as a 7-year-old. So of course, as a 47-year-old today, this is easy. 15 hours of work. Come on, that's a breeze. I could do that. I enjoyed it. So hope that answers your question. Be a good role model yourself. And I know you are. You're a good man. And I'm sure they're going to pick up on your habits. I'm positive. Last question. How do you backtest option strategies? How do I backtest option strategies? Boy, I'm a little bit old school, so I'm probably the wrong person to ask. I haven't really done a whole lot of research on what softwares can sort of expedite your backtesting process. I love doing it old school. Even if there was backtesting software, I still like doing it with an Excel spreadsheet and live trading over multiple years, because I find the process of the testing and live trading to be where I get the best ideas. I get new ideas as I go. So essentially what I do, all strategy building will start with some type of hypothesis that you have. You'll have some idea about the markets, how you think the market moves, or you might see some type of pattern. You think, I'm not sure if I recognize something, but there's something there, right? So then I'll just take some capital. I'll take $25,000. I'll get out a spreadsheet. Let's say it's an iron condor strategy back in, 2010 when I started backtesting, sort of finalizing my iron condor strategy, launched it in 2012. So this is about the right time frame. So 2010, I'm there. I put SPY at the top of the page and I trade one lot iron condors and I just try to gather the most amount of data. So I will sell just a one lot, right? You don't have to risk your capital, but you have to be live in the markets. So I'll do a one lot of a 75 days to expiration. I'll do a 50, I'll do a 30. And then within each of those trades, I will record when it crossed an 80% stop loss, a 50%, a 25%. I will do, I'll sell iron condors during low, mid, and high volatility. I'll do calendars when it flips over in a 40 percentile of volatility, like 10, 15 trades open at the same time. And I'll just track them all for a couple of years. And what I'm essentially trying to do is gather the most amount of data I can over a multiple regime period. So it might take a year. Like if you get lucky and you get both a low vol and a high vol period, you might have the workings of a functional strategy within a year and a half. But if you get like 2016 all the way through 2017, it's just one constant low vol regime. Well, you can't test your risk management control in 2017. So you would have had to wait all the way to Volpocalypse in February 2018. You would have to, and just one instance. So you probably would have had to wait for Q4 2018 when the markets went down 20% again. And then you can sort of say, okay, I've been through the good, the mid, the bad, and I can tell. And I've got 200 live trades, I've got data, I've got a spreadsheet, and then you just parse through it and you try to find the recognizable patterns and just optimize it that way. And within 2 or 3 years, you've got yourself a functional strategy. And then the process begins. Okay, now I'll dedicate 5%, 10% of my portfolio to it, but it's not done yet. I mean, of course, markets change and you have to evolve with it. And so it's a fun process, but that's what I do, real old school style. I know let's say you're trying to test out a new earnings strategy, for example. I know there's softwares that you can just type in, okay, Nike, 10 days before, what would have happened if I sold a whatever delta straddle, 50 delta long straddle, or I sold this 2 days before and I closed it 2 days after. We're in the AI world now, so I'm sure those exist. But I just feel like you'd be missing a lot of those little details that it's just, backtesting and strategy building, it's becoming a lost art. People have an idea, they go off, what is that? Like they see the squirrel and they just go chase the squirrel, or I call it chasing shiny objects. People have no patience. They have no long-term view of anything. They're just like, oh, I have an idea. Oh, that didn't work. I have another idea. Oh, that didn't work. Oh, there's a losing trade. I didn't like that. Oh, here's a better idea. There's no focus anymore. Like, I mean, of course, the TikTok generation can't watch a video for longer than 3 seconds without scrolling. So what I would suggest is you actually try to adopt some old school principles. That just reminds me of a funny quote I saw on Twitter. Somebody said, sometimes being old school just means you're old. And I kind of like that quote, even though in this case, I really do think that backtesting the old fashioned way it's a lost art, and you should try to bring it back. So that's what I would say. All right, boy, I'm going to have to do way better at time management here. And like I said, as we get more questions, 13 shouldn't be that much. Boy, I can really talk. But some of these questions are too long. So maybe next week I'll do like 5, and then I'll jump over to the chat and I'll do 15 minutes of the chat, and then I'll circle back and do another 5 of these, and we'll bounce back and forth because I do want to mix it in and get some live questions as well. So let's do... Oh, you know what? I didn't even do my mailbag. I created this little thing today.
Welcome. You've got mail.
I created all these like segments so that when I launch a new segment, I'm going to have, you know, an introduction. Anyway, you get the point. Kind of cool. I'm kind of a nerd about stuff like that. I think it's kind of neat. But I didn't even get to my mailbag question. So I'm going to have to push that to next week, and I'm going to have to do way, way better at time management. But honestly, I think those were good questions. I hope everybody agrees that those were some solid questions. I think we covered a pretty wide range of interesting topics. So thank you, everybody, for that. We're not stopping. I'm going to keep going here, but I really do appreciate people, you know, get your questions in on Monday or Tuesday. And yeah, I think that's a good idea. 5, go do the live chat, 555, do that. You know, so no background sound, looks good. Okay, let's see. Right, best not to use alcohol or narcotics when working. It's grape juice, I swear. I mean, technically it is, right? Chardonnay's made with grapes, right? I think I heard that somewhere. My wife's doing her almost level 3 now in her sommelier courses, so she's very knowledgeable about wines, all the different regions around the world, and she's super into it. It's really great. I don't know a whole lot. I basically have a pass-fail, system still. It's either good or it's not good. That's the extent of my wine drinking. So this good, but maybe she'll teach me some good stuff. We were actually supposed to go to France last year for 6 weeks, Burgundy, Bordeaux, Margaux, Champagne, and this silly VTS Options course has just got me so busy I had to cancel the trip and just work my normal 16-hour days. I feel bad, but as soon as that course is done, I definitely owe my wife a trip to France. So if she's watching, or maybe Italy, she's also interested in Italy. Do you see VIX Exploding? In any moment, exploding, maybe, in any moment, at any moment, I'm guessing. No, I don't play that game. So right now, volatility is what you would consider low. Now, technically speaking, the average VIX, let's get the VIX index here. The average VIX is about 1950, if you're talking about the mean. The median, the middle 50th percentile, is about 1750. And the mode, if you're not familiar, the mode is the most commonly occurring value in a series of values. The mode of the VIX is 12. So you could make a case that the VIX of 1974 is high, but like I said before, I always do relative adjustments for everything, right? A nominal number means nothing. So a VIX of 1974, who cares? It's quite clear the VIX is low based on where we've been. You could make a strong case that this is a low VIX. So your question, if I'm assuming that that's your question, am I expecting the VIX to explode any minute now? No, I don't play those contrarian games where I see a low volatility and I think, oh, it's definitely got a spike, right? Volatility's low, so inevitably it has to come back up. A lot of people play those contrarian games and they often forget that volatility, as I've often said in my articles and stuff, that volatility begets lower volatility. It's just, it can stay low for a very long time. It can stay low a lot longer than people think it can. So what I think about the VIX exploding or not exploding, I can have an opinion. I'm going to say no. I don't think volatility is going to explode anytime soon. But that's irrelevant because whether I think it is or whether I think it isn't, it's not going to affect my trading at all. I'm still going to stick to my strategies. And these strategies are based on volatility metrics that are largely out of my control. I've built these, they've been trading live for, a decade, and I just track volatility metrics, and they tell me that, look, based on where we are historically right now, there's really no historical reason to not be long equities, short vol, not in size or anything, and certainly not undefined, but long equities, short vol. I mean, for the last little while, there's really no reason not to be. So whether I believe the VIX is going to explode or not is totally irrelevant. I'm going to wake up tomorrow. I'm going to mine all the data. It's going to take me 30 minutes to input all the signals. And then the strategies are going to spit out the thing, and I'm going to send it to the VTS community. It's basically what I'm going to do. What I think is going to happen doesn't come into play at all. It doesn't matter. But if you want an answer, like, I'll answer it. No, I think people are exhausted by the up, down, up, down. I wouldn't be surprised if we had a couple of months of, relative calm. I think people are done with hedging and have those hedges just expire worthless month after month, week after week. So I could totally imagine that we go through a relatively calm period for a month or so. It wouldn't surprise me a bit. Is there a lot of traders in Dubai? I don't know. I don't speak to anybody. I don't have any friends yet. I haven't really done anything yet. I'm a member at the golf course. I've only played 4 times, and twice I played alone. Both other times I played with pretty cool guys. I met a guy real estate, and met another guy that's, don't know what he does for a living, but we played twice together actually. But I really don't have any friends yet. I got to get out more. But I told you what I did today. Like, I worked for 15 hours straight today. There's not a whole lot of time for socializing. I've just got shit to do, and I have too few hours and too much work to do. I don't have much social life. My wife's a social butterfly, I always call her. I'm on my computer, I'm doing my work, I'm listening to, relevant things, I'm editing videos for 15 hours every day. That's just what I do. I work out, and that's it. That's really it. Drink wine with her. That's it. Okay, this is awesome. Yeah, Aaron, you're absolutely right. 41 people, there's 43 now, 44 now. I saw there was even 50 at one point. How come there's only 12 thumbs up? So help me out. It actually helps a surprising amount when people hit that thumbs up. YouTube, the algorithm is all about engagement. So if you are still watching, it's too late. I should have probably said this in the first 1 minute of the live stream. I see there's 1 thumbs down. That's also counts as engagement, so thank you for that. I can't imagine what I said that caused you to thumbs down. Maybe I have a hater in this world. I'm not sure. I can't imagine I have a hater. I've never done anything to... I'm not controversial. I'm not, I don't give these unrealistic expectations. I'm the goody two-shoes, risk management, responsible investor, long-term consistency. I'm that guy, so I can't imagine why anybody would dislike anything I've said, but that actually counts as equal engagement to a thumbs up. So thank you. An overlooked part of an online question not answered. How do you trade with a U.S. brokerage from another country? Oh, I get it. Okay. Don't they have measures to limit once? Well, okay. So the truth is this is quite a modern world, and you can open bank accounts in, I'm not willing to say you can do it in 200 countries, but I'm sure there's at least 100 countries where you can just walk in with a passport and open a bank account. Like, it's really not that difficult these days. As far as opening a brokerage account, again, you are going to need a legal residency. No matter what you do in this world, if you don't have a legal residency, someone will make you a legal resident. Like, if you just pass through a country, they might grab you. They might. I mean, you might be on their radar somehow. And so you want an official residency. And when you have that, you can open any brokerage account you want. Might be international. I use international accounts. I use Interactive Brokers. I use Interactive Brokers and ThinkorSwim, but I believe both of them are registered to Taiwan. So that actually reminds me, I should probably update my residency to Dubai. But the point is, like, you need a residency. You just do. It doesn't mean that you have to live in that country. You can get multiple residencies. I'm still a resident of Panama. I don't live there. You don't need to Like I've heard of people who have 10 residencies. There's nothing wrong with getting multiple residencies. Multiple passports, that's a different story. Some countries don't allow it. Some countries, it'll take you 10 years to get a passport. Like in Dubai, I'll never have a Dubai passport. This is one of the hardest countries in the world to be a citizen of. But to be a resident, it could not be easier. So, yeah. Apologies about that. But yeah, get yourself any residency, hire a lawyer, $6,000 on the cheap end. I spent, like I said, about 16 for what I felt was, the best name that popped up on Google, just to make sure it's done right. But you can even get a Dubai. Like Dubai is a city, right? It's an emirate. There's 7 emirates. You can register in any one of the 7 emirates. So you can go into the other ones and get your residency there, which is a fourth of the price, and then you can just live in Dubai. Like once you have residency in the UAE, you can live in any of the 7 emirates. Now, I will warn you that pretty much only Dubai and Abu Dhabi are liberal enough that you would want to live there. I think the other ones are, I'm not sure I would feel comfortable culturally in some of the other emirates, but Abu Dhabi, Dubai, you can live in either one of them. So just do it. Just go through the process. It won't take any time at all. Not Dubai. You can do it anywhere you want. Montenegro. You can do it in Portugal. You can do it in wherever. Just get a residency. Don't try to think that if I never stop moving, they're never going to catch me. Yep, they will. They have teams of people trying to catch people doing that. Do it right. Do it legal. Same thing I say in all investing. Do it right. Do it legal. Do it responsibly. You'll never hear me say, oh, you'll be okay. You'll just short a little bit of vol. You'll be okay. Just a few naked calls. You'll be fine. No, you will not be fine. It will blow up eventually. And no, you shouldn't evade taxes. Eventually, someone will catch you. So do everything on the up and up, and your life will be much smoother. And fortunately, lawyers make it super easy. You just show up and sign a paper. It took me 5 minutes. Process took about a month, but it took me 5 minutes. Easy, easy. All right, VIX futures go all the ways, goes lower and lower. Can we short? How should I interpret that question? I'm assuming because you're talking about for several months now, the futures have been decaying. Is it too late to short? Is that your question? If so, and I apologize if I'm interpreting that wrong, but if so, yeah. This is one of those myths too about the whole contrarian thing where people think, okay, you short vol after it spikes, and you go long vol when volatility is really low, right? I guess to some people that makes sense. Historically speaking, I mean, if you want to talk about statistically speaking, what works the best? When volatility is low, you short volatility. When volatility is high, you go long volatility. I know for some people that sounds counterintuitive to them, but that's the reality. Statistically speaking, you will make a lot more money and you will have much better risk management if you short vol when it's low, or at least mid to low, and you go long volatility when it's mid to high. That's sort of the sweet spot there. So your question, if that's what you're asking, yes, it's not ever too late to short vol when it's low already. Obviously, you will always want risk management in place. That's true of all volatility entry points. But volatility is no more dangerous on the spike end when it's low as mid as high. It's really not. And in fact, the high is probably more dangerous, to be honest. When volatility is high, that's when it can spike the highest, the fastest. So if you're in the habit of waiting for it to spike and then shorting it, you'd be in a position where if you think back, like February 20th, 2020, volatility started to creep up, right? UVXY went from 10 to 15 and then to 20. There'd be a lot of people who are like, that's it. It doubled. It almost never doubles. I'm in. I'm short vol. Well, 3 days later, it was at 35. 5 days later, it was at 60. 10 days later, it was at 90. So if you're doing that old, contrarian, I'll wait for it to spike and then short vol, you could be walking into, the steamroller, basically. No, statistically speaking, you are safest shorting volatility when volatility is in a reasonably low range. So that is not financial advice, by the way. I'm not telling you to go out and short volatility right now. I'm just saying that if your question was, have I missed the boat? Statistically, no. No, you have not. What would be an environment for a huge VIX spike? Could the high convexity from 0 DTE and VIX calculation make it rise faster in a black swan event? Well, now you're thinking, yep. I'm watching it. There's nothing I can do. Like I said, my hands are tied as far as my strategic, systematic strategies go. But there is a potential black swan on the horizon, and I touched on it recently that based on, my brain is marshmallow right now. It's late. Capital allocation ratios, whatever you want to call it. Essentially, this is one of the things that caused the Volpocalypse spike, right? That didn't happen in a vacuum, and that didn't happen because, the short vol retail people got ahead of themselves and it spiked the volatility ETF market. That was just the result of other things that were happening behind the scenes. So essentially, on February, I feel like I want to say February 2nd, the Friday, but it might have been midweek. I think it was Friday, February 2nd. Yeah, it was definitely Friday. The Fed basically changed the regulations around capital requirement ratios. So this caused a huge problem that, a lot of institutions that have these ratios where you're allowed to stretch your short volatility positions further than you ordinarily would be allowed to regulatory wise. They switched that rule on February 2nd. So February 5th comes around, it's Monday. If you remember that day, the VIX was fairly calm early on, but throughout the day, it just kind of ramped up into this crescendo of volatility where the VIX eventually spiked 115%, 115.6%, the highest spike ever. That largely happened because there was a lot of jockeying of positions around that volatility because people now have different capital requirement ratios that they're going to have to scramble around on Monday and fix this before it actually marks to the clearinghouses at the end of the day. So that caused in itself what was already going to be a pretty large VIX move, right, on that day. And then you've got the double problem where you've got $5 billion of notional value in the VIX futures or in the VIX products, the volatility ETFs, that they all have to do an aftermarket rebalancing at the end of the day. But you've already got a whole bunch of firms and institutions and all these big players. They're already going out and being forced regulatory-wise by the Fed to go buy those hedges and to go jockey their positions so that their capital ratios are all in line with the new rule. So there was already going to be a lot of last minute hedging. And where do people hedge? Well, S&P for sure. That's going to cause problems with the VIX index itself, but also VIX futures. They're buying VIX futures. They have to change their, they have to close out some of those shorts and maybe they can't. So they have to hedge those shorts. Caused a big problem. And then at the end of the day, there's this big problem. So I say all of this to say the Volpocalypse event was caused by two things, not just one. It was caused by the Fed changing those ratios. And then also the aftermarket rebalancing where you've got all the short and the long inverse products and the long products. They all have to buy the futures at the same time. So it causes this big sort of feedback loop. And at the end of the day, it all met into this big Volpocalypse crescendo, right? Volmageddon. I say all this to say, at some point, this zero DTE stuff where people are kind of faking out the clearinghouses by, taking on intraday positions that they know full well that at the end of the day, they're going to close out before and they're not going to get marked. At some point, this is going to be cleaned up. And when it is, we don't know what's going to happen. I don't know what's going to happen. I'm not on the regulatory side. I'm not in the financial industry. I don't actually know the inner workings of these funds and these ETFs and all that stuff. So your guess is as good as mine as to how bad things could get, but there is a lurking black swan event there. And that is, not many people talk about it, but Volpocalypse didn't happen because of XIV entirely. XIV was the sort of the last domino to fall at the end of the day, but that was going to be an ugly day. And it was kind of marked on the calendar much earlier than that. So I suspect, where's your question here? I suspect we might be facing something similar-ish where there is a current loophole that could at any moment be closed. And if it is closed, what would happen intraday if that suddenly changed? I don't know. Maybe nothing. Maybe something bad. I don't know. Again, my hands are somewhat tied. It's not like I'm going to be buying constant rolling hedges just predicting that eventually some terrible event might happen, because it might not. But it's not nothing. It's something to think about. So again, obviously the same investing rules that I've been preaching for a decade now apply. Defined risk options only. If you're shorting volatility, do not, under any circumstances, listen to any clowns on Twitter saying that it's okay to sell undefined risk. It is not, and it will bite you. Don't do that. Those people are not actual traders. They're Twitter traders. They're doing it for following. Don't do that, because there are black swans lurking. It might be a flash crash. It might be a geopolitical event. It might be a cyber attack. It might be zero DTE regulations changed and capital ratios adjusting, and we might get another volpocalypse. Who knows? Be responsible. Know that there's risk on the horizon, but don't be afraid of it. Like, we don't have to change everything we do because we think there might be something lurking there. There might be something lurking in the repo market. There might be something lurking in the real estate market. There's lurking everywhere. This economy is, everywhere you look, I can make a case that it's going to fall off the rails. And then give me 10 more minutes and I can make a case of the opposite. Oh, actually, we're fine. It's going to be just fine. So defined risk, always. Risk management, always. Small allocation size. Diversified portfolios. Trade only products you understand and you know intimately well. All the same rules apply. VX is about 2095. Can it go below zero? No. The VIX futures, they're not based on the VIX index, but of course they do meet up at expiration. So the lowest VIX close ever was 913, the lowest print. So, it dipped slightly below intraday, but 913. You're never going to see the VIX futures go to zero. How could that happen? No, it can go low, but what was the lowest ever? I don't know, maybe slightly higher than 913. That's about what you're looking at. 2095 is high-ish, but like I said, relatively speaking, it is low. In your table, short vol bias, a higher for M1, M2 VIX futures. What does this actually mean? I love questions that are super specific to stuff. So let me make sure I'm answering. I got so excited there, I forgot the question. I love it. Short vol bias is higher for M1, M2 VIX futures. What does this mean? Okay, gotcha. Okay, M1 and 2, all of them have a short vol bias. So M1, M2 VIX futures higher. It means if the M1, M2 VIX futures contango is higher, technically speaking, the higher that number goes, the better it would be for a short vol position. So it's not a cut and dry thing, like the higher contango gets, the stronger the signal is. I'd say something right around, say, 7 to about 14% contango would probably historically be the best short vol positions to enter those trades. Above 14, it doesn't mean that a 20 contango, because it can get to 20, it can get to 30. It's been at, 32, I think? Do I have that data? Is that spreadsheet still open? How many spreadsheets do I have open? What's the highest M1, M2 contango? There it is, 30, where is it? 33.75, and the lowest is 33. But it doesn't mean that 33, like way up here, these are better signals. They're not. Like once you get above about 7 or 8, this is all pretty strong. But what this is showing is the short vol bias for all of these metrics. Essentially, the higher the VIX futures contango goes, you would bias a trade. If it goes lower and it goes negative into backwardation, of course, that's not a good time to be shorting volatility. And then, of course, we've got the percentile rank. Right now, it's slightly lower, but 41st percentile, 41% of all contango values have been lower than it is right now, and 59% have been above. All of these metrics have their bias. So, for example, my trader's VRP, the higher this number, technically the better short vol signal that would be. The cash VIX oscillator, one of my favorite metrics. These are all things that I've designed myself. You won't find these anywhere else. These ones are super common. I've got articles and video. Everything you see in blue has an article. So if a person were to click this, of course you'd have to claim your free trial to VTS to get these, but there's articles and videos for everything. Everything you see in blue, like these are all, you get the point. It's either articles or videos. And when volatility... Right? So Here, for example, the higher the cash VIX oscillator is, the better the short vol signal. The lower my volatility barometer goes, which means lower volatility means that you would want to short volatility. Like I said, as volatility goes down, this is counterintuitive to some people, but that's actually a better entry point for short vol. A lot of people think that when it goes low, well, now I got to flip it over and go long vol. No. Low volatility is the short vol signal. High volatility is the long vol signal. Ish. Like if the VIX is 80, you don't go long vol, but if it's in the 80th, 90th percentile, decent to start looking for those long vol entries. That's what it means. What time is it? Okay, so I should just heads up everybody. We're way over time again. If my camera shuts off, like I don't have it plugged in, it's basically on battery power. If my camera shuts off, it's not me bailing out on something like, oh, somebody asked a really tough question and sorry, I'm going through a tunnel, I lost service. No, it's my camera might actually just die right now. So recently bought a 0 days to expiration put with no intention of letting it expire. Don't like the sound of that. When it was in the money, Interactive Brokers starts flashing about a post-expiry margin alert. Is this the software assuming I want to exercise the put? How can I stop this? Is it possible? Well, options that are left to expire will get exercised for you. This is not a choice that you have. If you have a short or a long, if anything expires in the money, it will be settled. I don't know. Give me 1 second here. I know I'm supposed to do this article for the website. The question is, did I do this article for the website? Iron condors. Bear with me because this is going to answer your question pretty much exactly. No, I haven't. So mental note, make sure I do the options expiration article. Essentially, you're going to get assigned that. Now, brokers, of course, have regulatory reasons. They have to tell you when your options are expiring, and it might even mark it in the software. Sometimes if you look at, for example, I don't know if I have any in the money right now. I seriously doubt I do. What would be in the money? I might have some VIX in the money. See, it's marked in the money, in the money, in the money. They have to do this. I have to close that because that's a secret strategy that's quite detailed and quite specific. That's coming later on, but I flashed it really quick so you guys can pause. Anyway, the broker has to tell you that. So essentially, I'm not sure if these are warnings like they're going to force you to do something, but throughout the day, they definitely have to give you their disclosures and say, by the way, we have to remind you, you have some options expiring. That's totally normal. I get those emails all the time. And side note, super important, don't put those to block because as annoying as it is that your broker's always giving you these emails like, hey, do you want to learn about the new annual meeting or something? And you just delete right away. And then the broker will send you something about, your regulatory changes or something. You're totally uninterested in it, or dividends coming in. Yeah, I know. Like, I know my products. I know when that's happening. But there might be times when you actually want that email. So don't send it to a burner email. Just deal with it. Don't send it to junk mail. When they warn you about your options expiring, sometimes I get pretty complex with my options, and I would be lying if I said there hasn't been a few times where I kind of forgot something was on. So you want that. It's annoying, but don't let them expire in the money because then you're going to wake up the next day, either Friday if they expire a Thursday, or for VIX, for example, VIX cash settles, so you wouldn't run into that. But any 0 DTE, you'll wake up the next day and you actually have a position. You might be long, you might be short, but yeah. That's weird. Somebody banging on the wall. I'm in a party hotel and there's a pool party right out my window, so somebody's having more fun than me. What else? Okay, I should probably wrap this up. Volatility looks like a very good trading opportunity here. The issue is having an honest ETF that's not designed to steal your money. Guy, VXX, UVX, they're not designed to steal anybody's money. They're not manipulated. They do exactly what they're supposed to do. consider the consider the correction we've had the past year, VXX down. The VXX trades based on VIX futures, okay? It's not manipulated. This is an open, freely traded market. People can make any volatility bets they want. The VXX is going down because it has quite literally nothing to do with the stock market. Now, it is true that there is about a 70% correlation or so between the two, but it would be a mistake to assume that the VXX is an inverse product of the stock market. It is not. It is totally unrelated. Just because stocks are staying, up, down, choppy, chop, does not mean that the VXX has to go a certain direction. Just because the stocks go down doesn't mean VXX goes up, and vice versa. So the reason the VXX has decayed so strongly in the last couple of months is because we are coming off an entire year of 2022 where most traders who were hedging their portfolio just repeatedly had those hedges be useless and expire worthless. And there has to, at some point, be some hedging exhaustion. So, it's not beneficial for people to look at volatility ETFs and think these are somehow manipulated or they're designed to do a certain thing. They are designed to track the front 2 months of the VIX futures. That's it. And they do it very well. They track exactly. Now, that doesn't mean that they won't go down long term. They will, but that's what insurance looks like. By very definition, if you were to plot on a chart what a long S&P 500 put option looks like, guess what? It looks like the VXX. That's what insurance looks like. It has to go down, has to decay long term. Markets wouldn't make any sense if hedging was free, right? Everybody would hedge their portfolio. No decay factor in the VXX, that wouldn't make any sense. So, of course, in a roundabout quasi way, yeah, I guess it's designed to go down because it's an insurance product and it goes up violently in short periods and then it goes down steadily over long periods. Insurance. Same with your car payments. Same with your house insurance. Your fire insurance plotted on a graph looks like the UVXY. That's what it is. It's an insurance product. So it's not manipulated. The reason that VXX has gone down so much more than you might have expected, given the market that we are seeing, where, the market's still down, I don't even know, 16, 18%, something like that. But the VXX, the UVXY, they've all cratered. Well, why would that be? The VIX futures is an open market. Anybody can do anything they want in that market. What are they doing? Just normal trading, hedging, exhaustion, I suppose. Like I showed before in my metrics, I mean, you can see it right here if you know what you're looking at, that, look, the front month percentiles are low. Like we're seeing the VIX 9D to the VIX ratio, it's low. But the mid to long-term products, those are higher. But remember, the VXX and UVXY are playing the front 2 months of the futures, right? We're basically tracking the VX30. Why? Oh, there it is. The VX30 constant maturity. We're tracking this thing. So if that goes down, then the VXX goes down, regardless of what the stock market does, regardless of what the VIX index does. These are not connected. They're correlated. They're not connected. No causation there. So the VXX can decouple completely from the market, and it does, as you're seeing right now. It can also decouple the other way. You can get a period where the market's actually steadily going up. Volatility products are just flatlined. Like that happens as well. So, as I say, one of the general rules of investing is know your product. If you're under the impression that these are manipulated and they're designed to do something specific and it's kind of robbing people of their opportunities to trade volatility, then you need to paper trade for a little while, or you need to, reduce it to the least possible, like, 10 contracts or, 1 contract, something like that. You got to know your products. Very good opportunity if you do know them, because not many people take the time to understand them, which it does mean there's edge there. If you can actually dive in and pop the hood and figure out what's causing those movements, you can find edge there. So NASDAQ dropped 33%, and many volatility ETFs didn't function as they're designed. I think I went over that. Yet they behaved exactly as they are designed. They tracked perfectly the front 2 months of the VIX futures. It just so happens that the open market of VIX futures happened to be bidding lower and lower and lower. People just aren't hedging with those futures at the rate that they were in the past. Maybe they are shifting over to zero DTE options on the VIX. Whatever it is, they're not doing it in the VIX futures market. So yeah, the path is down, and it's not overly surprising. I don't mean to keep picking on you. I like questions like this because a lot can be learned unpacking these things. I'd say your language too, the way you're speaking about these products, you're positioning yourself as if somebody's against you. Even if that was true, you don't want to approach life as a victim. You don't want that mentality in your trading. You're not a victim. These are open products that there's a prospectus there for you to study. There's all kinds of opportunity for you to find your edge and outtrade other people. So I'm not saying you're pretending to be a victim. I don't mean that. I don't know if that sounded condescending. I just mean that some of the words you're using, it sounds like you're positioning like a them versus us type of thing. It's not. It really isn't. These are very well functioning products and great opportunities for people who see it that way. So VXX calls look good to me. I hope you don't mean shorting them. It would not be unwise to be accumulating a defensive position that's heavy in volatility options. You said it would not be unwise. I wouldn't say it's wise either. Like that would be you're playing a contrarian, and usually contrarians lose. What ends up happening is you start accumulating this position. It's going to bleed capital over time. Statistically speaking, volatility goes low. It's just going to go lower. And you're going to be bleeding your capital down. And by the time you do get the inevitable spike that you're expecting, which will happen if you wait long enough, might be a day, it might be a month, but at some point volatility is going to go back up. When it does, you might have lost more money in the bleed, and you're going to need a monumental spike just to get back to break even. That can happen when you're playing a contrarian and you're buying long volatility when volatility is bleeding down. Like I said before, it sounds counterintuitive, but dive into the math and the numbers. The best time to short volatility is when volatility is mid to low, and the best time to go long volatility is when volatility is mid to high. If you stay within that parameter, you're going to have better risk management and better trading outcomes. I would not, again, it's not investing advice, but I would strongly encourage people not to try to be a contrarian against the market. Typically, you're going to lose in that equation. There will be times when you catch it right and you think you're a genius, but we are not investing for 6-month windows here. We're investing for 30 years. We need to make sure we're doing the right things for 30 years. Being a contrarian for 30 years will get you bankrupt. It just will. So bad habit, don't do it. Thank you for the questions, though. There's some good stuff in there. Yeah, good questions. Thank you. VX margin's too high. There's just better yields elsewhere. Yeah, I would agree with that. That's a consideration whenever you're trading. Like efficiency is part of it. When you're talking about trying to make higher returns on the margins, the difference between making like long-term over 30 years, the difference between 1 or 2% rate of return is massive. If you make 10% a year for 30 years versus somebody who makes 8% a year for 30 years, that's going to add up, like compounding over time, to a pretty significant difference. You're talking about potentially $1 million difference there, hundreds of thousands for sure. So getting those little efficiencies, making sure you're trading the margin efficient things, making sure you're, whenever possible, tax efficient, making sure your commissions are as low as possible, making sure that you understand how to get the midpoint when you're trading bid-ask spreads and your slippage doesn't cost you. These are all tiny little edges, and when you add them all up, it definitely leads to a better rate of return. Usually the volatility on the monthly option expiration day is very low. The major indices barely move, but once or twice a year, they rise, drop a lot. Would you explain the major reason for these? I would say chance. largely chance. There's oftentimes people look at things like that and they think they see a pattern, but typically it's either a combination of recency bias or negativity bias. Humans are pattern seeking creatures, and we tend to see things that are not there. Maybe it's there in the short term, but I would imagine if you extrapolate that test backwards, you would find that it's not actionable as far as trade signals. Oftentimes people do that. They're like, wow, like every Wednesday, just like clockwork, the market drops. But the second you try to apply that to an actual trade, you find that it flips and it's no longer applying. So I'm not a big fan of stuff like that, especially when you're talking about volatility specific. I don't know if you are here, but you got to remember that for volatility, the VIX futures, the cash VIX term structure, these are all a smooth transition from day to day and flipping over the expiration cycles. Like when the VIX futures go from having 1 day to expiration to expiring to going back to having, say, 27 days to the next expiration, this is a smooth transition. There is no step down like it's a good time to short right on expiration or the day after. The calculations for VXX, UVXY, SVIX, UVIX, all of these things, the calculations are completely smooth through the days. It is a rolling VX30 constant maturity. So there's no flip points there. There's no gamma flip or anything like that. It is just probably you're just seeing a few patterns that maybe in the short term you noticed them, but I would encourage you to try to expand your window, and you might see some of those patterns disappear. Curious to know why you use ThinkorSwim and Interactive Brokers. Well, I started my trading with ThinkorSwim because it was the easiest account to open an international, and mine's connected with my Taiwan residency at the time. So this was all the way back in 2006, I believe. I opened my TOS account, and then fees were very high back then. I don't know how long you've been trading for, but TOS used to be one of the highest commission brokers out there. And I'm a pretty heavy option trader, even going back 15 years. So I kind of got sick of paying $9.99 for every open and close. Like trade transactions back then, for some of you young punks in the comment section, you might not remember this, but we used to actually pay $10 for an entry and exit. Plus you pay 75 cents per contract. So when I started to ramp up my volume, TOS, you can contact your broker and you can ask for discounted commissions. And everybody should do that. The worst case scenario, they tell you no. But I contacted the broker and they told me they'd give me 60 cents. So, big discount there. So in roughly 2010, 2011, I moved all of my capital over to Interactive Brokers. But while I'm talking, I can actually open this and show you. I moved everything over to Interactive Brokers because back then the commissions were cheaper. So for the last, 10 years, what I've been doing, and I'll show you that in a second, what I've been doing with my IB is my long-term portfolio, still is today, but I'm kind of in the process of switching. And so what I would do is I would plan all my trades with TOS, and there was only $10, or no, it wasn't even 10. Oh yeah, $25 or $30 or something in the TOS account for almost 10 years. So I've got it here. I can show you this, what I'm talking about here. So I recently funded this so on our live streams, we could actually have something to do some live trading, right? So I funded this account with $132,000 in November of 2020, right? And this is what we use for our live streams so that we can actually track the trades over time. But watch this. So if I drag this back to, say, I don't know, how far back till you can actually see what I'm getting at here. How about that? Is that going to do it? Yeah. So you can see this step, right? I had $35.42 in my TOS account for 10 years. And what I would do is I would use TOS for all the analytical stuff because this is super nice to look at. And everything that you do in TOS is beautiful and the platform and it's intuitive. So I would do all my stuff here. I would calculate my options trades. I would, figure out what I'm going to do. I would even go into the actual things and I would see the bid ask prices because they always show really well here. And then I would just jump over to Interactive Brokers, and I would execute the trades. So for 10 years, I've been doing, well, 8 years, because I actually funded it. What did I put 10 grand here, and then I did maybe 6 months of trading there like that. And then I funded it for the live stream account. So while I can say I do use TOS, because it's my favorite broker, technically speaking, I'm an Interactive Brokers guy, but it is the worst software in the world. It's the ugliest thing you've ever seen. So unless you had a specific reason to use Interactive Brokers, I would say skip it. Yeah, the commissions these days, everything's more competitive. So TOS it's still on the expensive side, but it's kind of fine. I might just move everything over to TOS, but if you're interested, you can kind of do what I do, like I showed you. There's only $35 in the account for 10 years. They didn't ask me to deposit anything. They just kept my account open, and I used their awesome software for 10 years, didn't execute a trade. That's my history. So I don't know. I would say I'm a ThinkorSwim guy, even though technically speaking, my main portfolio is at Interactive Brokers. And I can't use things. I've heard Tasty's pretty decent as well, but just because of my international status, they don't allow me to open an account, so I can't test that one. Have I looked at other brokers? Tasty works, yeah, maybe. I've heard great things about it. Not surprising, it's designed by some of the same team that did TOS, so I would expect it to be very good. But no, I'm happy with TOS. I think it's great. And they do treat international accounts really well there too. So, all right, last one, I swear. Tastyworks is built by Tom, Tom Sosnoff, right? By same people who did ThinkorSwim. Do you have any experience with Tasty? No, I do not. But again, heard nothing but good things about it. Visually, looks great. I've seen it. It seems very intuitive as well, easy to use, very user-friendly, which is good because Interactive Brokers is not. You wouldn't believe how many emails I get from people who have a hard time executing trades in Interactive Brokers. It's a nightmare. I have a super old version because I don't keep upgrading. It's such a terrible platform that I don't want any confusion at all. I just use, I think I've just been refusing updates and downloading old versions for probably 7 years now. Mine looks pretty bad, but there was a time when I got a new computer that I actually did the new one, and it's even worse. It's just awful. I don't know why they just can't get it right, it seems. It's just the worst. But good statements, good customer service, fairly cheap commissions, and I negotiated good prices. Interactive Brokers was even better than TOS, so my fees were substantially cheaper. When I moved over in 2011, it was just night and day difference with commissions. These days, it's pretty close. All right, that's it. Got to call it. That was way too long. But again, my fault. I answered all 13 questions in a row. Next time, I will definitely bounce around. And thank you. I feel like there were some solid questions there. So tomorrow, I'm going to go to the gym and put my computer at the side of the room. I'm going to edit this. I'm going to timestamp it all. So tomorrow, sort of dinner time-ish, all the timestamps will be available for people. And if you missed some of it, you can come back. If you heard something and thought, oh, I want to circle back and listen to that one again, the timestamps will be there. So wait, I always say that. Last one, and then there's one more. What does this mean? 111 minutes Q&A, new record, not even close. I can talk. This is a product of not really having a social life. And as soon as I get on camera, I feel like there's 40 people in the room and I'm having a conversation with all of you. I could easily just go get another drink and keep going, but I know that this camera is going to cancel. My first live stream I ever did, I was terrified. I'm still nervous right now. Like even today, I'm nervous. I think my first live stream was three hours and 20 minutes or something. It felt like 10 minutes. Just time flies when I'm doing streams. So I should get a huge clock that's in the corner, do 1 hour, because I don't want to waste all the good questions. You can come back next week and ask more. As you've seen, I answer everything. I answer everything from, here, I got my interest. I'll answer a million other questions. Whatever you ask me, this is the only real human interaction I get, aside from my wife. I maybe have a couple of friends in this world, a couple of golf buddies. That's it. I'm not antisocial. Like, I know how to hang out and interact with people. And when people meet me, they like me. But I just, like I said, I work 15 hours a day. How am I going to possibly make time for friends? And that's not even, I need to work more than that because I've got this stupid VIX course to finish. So 15 hours a day isn't even enough. I won't have any social life for the next 6 months at least. But ask me anything you want about these and keep going. Not tonight. I am actually going to call it. So thank you very much. If you don't mind, give it a like on the way out. I should have asked earlier on, but hey, it's never too late. If a few of you on your way out the door just hit that like button, that would be awesome. And again, Monday I will post in the community section for next week's live stream that will be Friday. So get your questions in and I will answer as many as I can. Keep them short. No paragraphs, please. Don't write a novel. All right. Thanks for watching.